Man, we just keep running in this chapter. There's so many nuggets, but it's time to get a little serious. Look, there's 10 costly mistakes I see investors make, 10 costly mistakes I see people make all the time, and nobody talks about them, right? So many of you try to talk about what a good investment is and how you find a good investment, but there's all of these things that are red flags. Now, no good investment doesn't have any red flags with it, but too many red flags means you need to run away. So let's start with rushing to make decisions. Look, somebody says, I only have so much time to make a decision, then I say next. Now, look, when you have invested, for me, in hundreds, I would say thousands, broken 1,000+ houses in my lifetime, I know the difference between a good house investment and a bad house investment. But the reality is, if you've only seen one, two, or three, you don't have the ability to make that decision. And so if you rush into it, you're likely to make a mistake, right? If you have invested into thousands of stocks, same problem. Same with investing into a business or crowdfunding. You can never rush. And if people give you a short time frame, I say next. There's always another good investment. Having been through what I've done, having made the good investments, having made some bad ones, having had the amount of success, I know there's always another one. Being pressured into financial decisions. Look, if they feel like they're pushing me or they're pressuring me, right? There's only so much spots available, or they sit here and say, look, you have to do this investment. All of that stuff, it's like the little butterflies in my stomach start to come up, and I'm like, no, I need to walk away. You got to trust your gut to a no. If it's a yes, that means do more due diligence. Always trust your gut, right? Relying on unreliable resources. One of my least favorite reliable resources, this is the third on this list, is relying on friends. Look, friends are a starting point to open the door to potentially making an investment, but don't allow them to be your due diligence. Your cousin's friend's uncle, who one time made an investment and bought some crypto, had success, is not a true indicator of previous performance being successful, right? Chapter 5, we're going to get into some rad keys on due diligence, but like self-proclaimed professionals. Look, if people aren't truly a professional, right? If they don't have the licenses, if they don't have the track record, if they don't have the history, you got to move on. Investing is something that I don't understand without education. Like, if it's too complicated for you to understand, don't make the investment. Right now, one of the most complicated things out there is AI. You're going to see 1,000 people with AI ideas, but the difference between an AI company you invest in and one you don't invest in, how do you make that decision? It's very special. It's very peculiar. I've probably been pitched a half dozen AI companies I refuse to pay attention to. I was pitched one recently I started paying attention to. They already have government contracts. They already have revenue. They already have income. That's not too complicated. P&Ls, balance sheets, there's always knowledge in that. Investing in private unreported companies. Look, if a company isn't transparent, if they don't have audits, if they don't have financials, if they don't have any type of third-party evaluation of them, time to walk away. Number 6, investing in a vehicle without disclosed tangible assets, right? When everything is just this mysterious income, when everything's just this mysterious way of doing things, right? Something with a real tangible asset, right, makes a huge difference. Deciding you've got to make this decision because you need money now. One of the big mistakes. Look, markets go up, and lots of people who make investments near the top of that are lots of times investing for a short-term game, and then the market crashes and now they're stuck. Now they got to sell pennies on the dollar. It's always a mistake. Always invest for the long term. That's one of those Buffett ones that I've learned over the years. Always allowing money to burn a hole in their pocket. I always say, look, sometimes people get an inheritance, they win the lotto. Sometimes they've been saving, but they suddenly realize how much they have. It's like a stick of dynamite for a lot of people. You got to breathe. Got to take your time. Doesn't mean you don't act, doesn't mean you don't make decisions, doesn't mean you don't do good investments. It means you got to not allow the money to burn a hole so you're not rushing. Making a greed-based decision. Look, if you're making an amazing return, like I had a friend who was making a 20% return on his investments, and he recently said to me, Dutch, this thing came to me, I think I can make 50% return. I think it's only a 9-month investment. That's going to be incredible. I say, run away. You're already making good, solid return. The greed is only going to kill you, right? When you're making good money, going to look for something else that's suddenly better and suddenly faster is a good way to get burned, right? Not considering inflation or other variables that could cost you the effect from an investment. 2022, I was seeing this investment on Facebook all the time. It was about these fourplexes, and they were talking about how in 2023, August of 2023, they were calculating all these returns, all of these investments, all of these things that were going to make people money. Anybody quoting future returns is full of crap, unless it's guaranteed. Look, the bottom line is if you're quoting future returns, you have to take into account, can cost of materials change? Can interest rates change? Can taxes change? I've been saying this for years, but in the last 3 years, we've experienced all of them. Hyperinflation, high interest rates, cost of materials changing, all of these things have shifted. And so if people are quoting future returns and they haven't taken all that into account and they're only taking in the account the growth of money, then you're likely to get burned. Look, these 10 costly mistakes are things that you must pay attention to. You start to hear things and you become like a detective, you become a decoder. And if you hear these things in people's language when they're sharing an investment, sharing something you can do, these are all reasons for you to do it. And I think anybody sharing an investment is probably likely a fault or at fault of one of these 10, maybe even at fault of 2 of them. But I think if you get to a third one, you got to run. You just have to run. And if you have 1, maybe a little more due diligence. If you have 2, maybe a lot more due diligence and a lot more deep diving. If you have 3, I always say run. So chapter 3, it's one of the most serious things in this entire book. Glad you listened.